and mortgage strategist Robert McLister. He's with, of course, MortgageLogic.news. Robert, it's great to see you. Can you give us a ballpark figure here? If I'm looking at if I want to get a variable rate for a mortgage 5-year term and a fixed rate, roughly what would I pay?
Well, the leading nationally available rate is 4.99% for a 5-year fixed through HSBC, and then you got 5.9% for the variable. So there's a fair bit of spread there.
That's interesting. So traditionally, of course, you would pay less for a variable, wouldn't you, because of the uncertainty?
Yeah, the yield curve's inverted right now, so variable's costing you a bit more, and it might cost you a little more if we get another hike from the Bank of Canada.
So what should I do? I have a mortgage coming up. I know nobody wants to hear about my woes. In fact, I'm a lucky man. First world problems, but I do have a mortgage coming up. I don't mind a bit of risk. I want to renew for 5 years. What would you recommend?
Well, right now, as we speak, if you were to believe the market implied pricing, which is for rate cuts in 2024, then a 1-year fixed or 2-year fixed are theoretically on paper your best bet. The 5-year fixed, pretty compelling on a rate basis. I mean, you're looking at 4.99% for a uninsured 5-year fixed or 4.49 for an insured. That's materially better rate. And a lot of people are forced to take those rates because the rate's lower. It makes the stress test easier to pass, and it's the only way they can qualify.
That's interesting. I want to get into that in just a second. What is a 1 or 2-year fixed rate, roughly, Robert?
You're looking at about 5.69% to 5.74% for a leading 1-year fixed rate right now.
So it wouldn't be completely illogical to go variable at this stage with a 5-year variable?
So personally, I don't think it's quite time for a variable yet. I'd want a much higher probability of the Bank of Canada pivoting, getting closer to that first rate cut. Right now, a 1 or 2-year fixed, if you're risk tolerant, if you're well qualified, is a pretty decent bet. Now, could you be wrong? Of course. And that's why some people are maybe gravitating to a 3-year fixed, kind of get that, middle of the road, best of all worlds scenario. But generally speaking, if you look back over time, the shorter you go in term, the less you pay over time because you're not paying that term premium.
Mm-hmm. Of course, the lender has to cover him or herself. Yeah, they don't know if inflation's coming back. Now, you have been writing about how a lot of people just are unable to refinance their mortgage right now. Why is that?
Well, rates are high, and that's made the stress test harder to pass, for one thing. It's actually a bit of a concern among regulators now. They came out with the mortgage tightening and the stress test, and they made the stress test tougher to pass. And what that's doing is driving a lot of people to the non-prime side. And so you're seeing like mortgage investment companies or corporations growing at 4 times the rate of bank mortgage growth. And, the latest data from CMHC suggests about 1 in 10 new mortgages is funded by a MIC, a mortgage investment corporation, which is basically a non-prime lender that's willing to take more risk, but they charge you materially higher rates. For a non-prime mortgage, you're going to pay 1 to 3 points higher plus fees. So what it's doing is it's bailing people out in the short term, but it's causing risk longer term because, the carrying costs are materially higher.
That's interesting. So people aren't able to pass the stress test at a bank? Is that the thing?
That's right. And, non-prime lenders aren't the only option in that case. You might go to a credit union, which lets you qualify, at the lower contract rate, the actual rate you're paying, instead of that higher stress test rate. But again, you're paying more for that privilege.
Now, we have heard that the regulator, the Superintendent of Financial Institutions, has expressed, I don't know if it's concern, but say that they are watching this phenomenon where banks are simply allowing people to roll over mortgages instead of sort of coming to grips with the problem. Is that happening? Are banks kind of putting it under the carpet here?
Well, the government's actually supporting banks working with borrowers who are experiencing hardship, and as they should. There's a theory out there that you let these people fail, it brings down home prices, and it's long term, it's healthy and good for the economy. Well, it seems like the politicians and regulators don't exactly subscribe to that theory. So. Listen, we're going to have arrears. We're going to have higher arrears. We're going to have higher unemployment. It's going to get worse before it gets better. But I think the government is on the right track in kind of minimizing the impact because housing is so critical. Debt is so high. You make the wrong call, and all of a sudden you have domino effect and home prices tumbling and people defaulting. That's not good for anyone.